Hi everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and today's market updates. As of today, we're going to be talking about the history of the past few Fed interest rate hikes to kind of predict the hikes expected for the upcoming end of this interest rate hike cycle. After 6 rounds of complete interest rate hikes since 1983, the U.S. Treasury rate was in most cases higher than the federal funds rate at the last time of the interest rate increase. Only in the period from March 1988 to June 1989, the peak after the 10-year Treasury rate was near 30 basis points below the federal funds rate. Combined with the situation of this round, we expect the 10-year interest rate Treasury yield as high to be at or near the location of the last rate hike. Historically, in March 1983, the Federal Reserve started to raise interest rates that lasted for 1.36 years, which raised federal funds rate from 8.5% to 11.5%, cutting interest rates twice and raising it 10 times with a total of 300 basis points. After the rate hike, the situation of the U.S. economy had changed. It is still generally sound. New non-farm payrolls continue to show growth, but unemployment and labor force participation rates remain unstable. But the inflationary pressure still exists, with year-on-year CPI growth and the core CPI year-on-year growth still rising after the interest rate hike. March 1988 to May 1989, the Federal Reserve began to raise interest rates to 6.75%, and then eventually the final federal funds rate target was raised to 9.81525%, a total of 301.25 basis points. From 1988 to 1989, the economy generally showed a stable growth. Employment remained in a stable range, and the labor force participation rates also remained stable, and the CPI also remained around 45%. From 1994 to 1995, the year-on-year GDP growth has remained above 4%. Driven by the increased economic activity, employment growth has continued and the unemployment rate has declined slightly. At the same time, inflation rate has fallen. In April 1994, the year-on-year CPI growth rate of CPI was only 2.4%. Although it increased later, the overall level was controlled below 3% and was within the Fed's comfortable range. Between 1999 and 2000, the federal funds rate rose from 4.75% to 6.5%, a 175 basis points increase and 6 rate hikes. Despite the Fed raising interest rates, the U.S. economy shows some complexity. Changes in new non-farm payrolls, unemployment rates, and other economic indicators suggest that economic growth has been subdued in some periods and has maintained its momentum in others. This change may be due to the influence of various factors, including global economic environment, internal economic policies, and other macroeconomic factors. From 1999 to 2000, the 2-year Treasury bond up for 126 basis points reached a stage high of 6.69%, while the 10-year bond up 114 basis points hit a high of 6.79%, then declined. In terms of time, the 10-year bond note fell for 4 months earlier, and the 2-year Treasury bond fell relatively late. Near the end of the rate hike, the 2-year and 10-year Treasury bonds began to correction in the months before the hike, up around 60 basis points, both higher than the federal funds rate. In terms of the maturity spread, the duration of the U.S. bonds was once again inverted, and the inverted degree was even greater than 1988. The maturity spread dropped from 28 basis points to negative 46 basis points, and the spread was compressed by 75 basis points. From 2004 to 2006, the federal funds rate increased from 1% to 5.25% of 17 times with a raise of 425 basis points. The U.S. economy continued to grow during this period. The GDP growth was mostly remained at 3% and 4%. Unemployment rate gradually declined during this period from 5.5% in 2004 to around 4.6% in 2006. During this period, the year-on-year growth of CPI was 3.3%. There was a certain upward pressure on inflation, but there was no sharp rise. The federal funds rate interest rate hike played a certain inhibitory role. From 2005 to 2018, the Fed began the process of a normal monetary policy. This round of interest rate hike began from December 2015 to December 2018. The target range of federal funds rate was raised from 0 to 0.25% to 2.25% to 2.5%. It rose for 3 and 4 interest rate increases, respectively, for 2017 and 2018, with each time at 25 basis points. In this round, the 2-year Treasury bond rose 242 basis points to the inter-cycle high of 2.98%, and the 10-year bond rose 187 basis points to the inter-cycle high of 3.24%. The 10-year Treasury bond fell 45 basis points to 2.79%, and the 2-year Treasury bond fell 31 basis points to 2.67%, both slightly above the federal funds rate of 2.5%, and the 2-year and 10-year maturity spread narrowed from 125 basis points to 12 basis points, with a cumulative decline of 112 basis points. From these trends, we can see that as for the peak time, compared with the pace of the interest rate hikes, the U.S. Treasury rate will usually peak at 1 to 3 months earlier than the last rate hike, while the 10-year Treasury note is synchronized about 1 month ahead of the 2-year note. In terms of the curve form, the maturity spread of the 2-year and 10-year Treasury yield narrowed in each round of the interest rate increase cycle. In 3 rounds of interest rate increase cycle, the maturity spread was inverted, and the maximum inversion was negative 45 basis points, negative 52 basis points, and negative 16 basis points respectively. In this round of interest rate hikes, a loan inversion of above 100 basis points is rare in history. Combined with the situation of this round, we expect the 10-year high to be at or near the location of the last rate hike. The trend of the final stage is still uncertain and generally depends on whether the overall macro expectations are stable. This is all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.